Welcome to the Opening Bell Report.
Today, we're looking at a financial analysis of Datavault AI, ticker DVLT. It's positioned as a high-risk, high-reward binary bet, basically aggressive growth guidance versus some pretty significant dilution risks. Let's just get straight into it.
Right, let's dive in. So a key theme here is really this tension, this pull between what the company promises and its financial reality. The report relies so heavily on management's guidance of $200 million in revenue by fiscal year 2026 to justify the whole massive reward idea.
But it accepts that number a little too easily.
It does, without enough skepticism.
As I understand it, the whole argument really hinges on that number, doesn't it? If they somehow hit that $200 million, the valuation looks, incredibly cheap. It's the anchor for the entire bull case.
Exactly. The report frames it as a 2x sales argument. But here's the weakness. While it notes this growth is just guidance, it treats the jump from, around 6 million TTM to 200 million as a fixed target.
Yeah.
There's no bridge. It doesn't explain how the company physically achieves a 3,000% revenue increase in just 2 years.
That's a massive leap. It feels like we're missing the actual mechanics of that growth. For an expert audience, which this seems to be for, just repeating management's projection isn't really enough.
Precisely. The analysis has to investigate the feasibility of that number. So the suggestion is to deconstruct that $200 million target, see if the whole data monetization story can mathematically even support it.
So instead of just stating the target, you analyze the unit economics needed to actually get there.
Yes.
I see what you're getting at. So if we were to build that bridge, what would that actually look like in the next draft?
Well, think about the breakdown. First, you calculate what portion of that $200 million has to come from the legacy audio business versus this new licensing engine.
And the legacy business is what, $6 million now? It's not growing fast?
Not at all. So the vast majority of that growth, let's call it 190 million of it, has to come from the new pivot.
Which is where these new patents come in, the AI bias detection and the real-world asset tokenization. The report flags those as the main drivers.
Right. But just listing them isn't enough. If those are the drivers, okay, how many licenses do they need to sell? What's the average contract value? If a license is 50 grand, they need 4,000 new clients in 2 years.
And if it's $500?
Then the volume requirement just explodes. The report is completely silent on this.
That is a crucial distinction. Without the unit economics, 200 million is just a number on a page. It would also be valuable to compare this growth curve to other successful pivots in the AI microcap space, wouldn't it?
That's a fantastic point. Is there a precedent for a 33 times revenue jump in 24 months without a huge acquisition? If you look at similar microcaps, that kind of organic growth it's incredibly rare.
So if the analysis can't find a precedent,
Then you have to flag it as a statistical anomaly. Don't just call it bullish guidance.
that completely changes the tone. It moves from here's the potential to here is why this target is almost impossible to hit. It makes the whole piece much more robust.
Exactly. It stops the analysis from sounding like a cheerleader for management. Okay, now let's look at the risks. The analysis correctly identifies dilution as the single biggest red flag, but it completely fails to quantify how that dilution rate affects the projected stock price targets.
This is where it feels a bit disjointed to me. It notes that shares exploded from 5 million to 285 million. It warns that your slice of the pie gets smaller. That's all laid out clearly.
I wonder, though, has the author really considered the impact of that on the numbers provided later? The report lists the technical target of $4 plus and a buy zone of 68 cents.
But it doesn't adjust those for future dilution.
Not at all. It creates this huge disconnect between the market cap thesis and the share price reality.
You can have a company's market cap go up 10 times, but if they issue 10 times more shares in the process, the stock price stays flat. The report just leaves the listener to do that math themselves.
So the suggestion here is to integrate the dilution machine metrics directly into the valuation models. Don't just list dilution as a risk. Show the reader the implied share price if the company has to raise the capital it needs to survive.
Let's run a scenario on that, just to make it concrete. The report mentions a $17 million cash burn. To survive that for another year, how many shares does DVLT have to print at current prices?
Okay, let's do the math. If the stock is, say, 75 cents, and they need 17 million just to keep the lights on, not even to fund growth, that's roughly, 23 million new shares?
And that's if the price holds. If they sell at a discount or the selling pressure pushes it to 60 cents, the dilution just spirals.
Exactly. So you have to recalculate the upside.
If the share count moves from 285 million to, say, 400 million to fund operations, that $200 million revenue year might result in a $1 stock price, not the $4 target.
That's a pretty sobering thought for a reader. It completely changes the risk-reward.
It does. I would love to see a fully diluted price target table in a revised draft. Show how that $4 target just drops as the share count rises. If the count doubles again, that $4 target becomes $2. That kind of visual adds so much value.
It grounds the massive reward in mathematical reality. Speaking of grounding things, let's look at the technicals. A key theme here is that falling wedge pattern.
Ah, the technical coil. Yeah, the report separates the technical coil from the sell the news history, and it misses a huge opportunity to explain why the breakouts keep failing.
Okay, so what I like is that it identifies the pattern correctly. But you're right, there's a conflict. The technical section suggests a breakout above 80 cents could trigger a squeeze, but the risk section says rallies struggle because of a wall of supply.
The two sections are fighting each other.
They really are.
And the report misses the causal link. The company is the wall of supply. They're likely using those technical breakouts as liquidity events to sell into the market via their ATM offering.
So the resistance at 80 cents isn't just trader psychology?
It's probably the company telling their broker to hit the bid. The suggestion is to merge the technical analysis with the solvency risk. Frame those resistance levels not as lines on a chart, but as likely zones for corporate dilution.
That connects the dots beautifully. So instead of saying traders use liquidity spikes to exit, the report could suggest the company uses the 80-cent level to fund that $17 million burn.
Exactly. Reframe the falling wedge analysis. Tell the reader, watch for a breakout at 80 cents, but confirm the volume is external buying, not internal selling from a filing.
And that links right back to the going concern warning mentioned in the report.
Explicitly link it. The stock can't squeeze if the company is flooding the ask side with millions of new shares. The analysis needs to say the technical breakout is capped by the solvency need. That's a much more sophisticated take.
It transforms a standard chart reading into a forensic analysis of the stock's behavior. Okay, let's pivot back to the fundamental catalyst, the section on the data monetization pivot. It identifies the right things, patents, silex, but it kind of lacks the depth to validate the quality of these assets.
Yeah, that's clearly laid out as the reason for the massive reward. But I wonder if we've really considered the substance behind the buzzwords. It lists AI bias detection and real-world asset tokenization.
They sound impressive, very on trend.
They do, but they're also very high level. The weakness is that the report doesn't evaluate the commercial viability of these patents. It just assumes patents automatically equal high-margin revenue. And in this market, everyone has an AI patent. What makes this one worth $200 million?
So the suggestion is to really scrutinize the quality of the pivot. Are these patents defensive, just protecting their tech, or are they offensive, actually generating licensing fees?
Exactly. And look at the Silex partnership. Does it bring in immediate cash, or is it just a strategic investment on paper? We see these all the time in microcaps, where stocks get swapped but no actual cash changes hands.
And that doesn't help the burn rate.
Not one bit. And the report notes a net margin of negative 1,394%.
That number is just staggering.
It is. And that's where the analysis needs to get real. It needs to ask, how much higher do the margins on this new licensing revenue need to be to fix a hole that big?
I mean, if you're losing $13 for every $1 you earn, simply improving margins isn't going to cut it. You need a completely different business model.
Precisely. And on the asset tokenization claim, is DVLT a leader here, or are they just adding blockchain terms to their filings to catch a bid? A quick check of R&D spend versus competitors would clarify this. If they're spending $200 grand and their competitors are spending $20 million, that patent might not be the moat the report thinks it is.
That's a really sharp insight. It forces the analysis to look past the press release and into the operational reality. So, stepping back, the overall critique is that the report is good at identifying the elements of the story, the growth, the dilution, the chart, but it treats them like separate silos.
Yes, it presents the bull case, then the bear case, then the chart. But in reality, the bear case, the dilution, is what prevents the bull case from happening, and it explains why the chart looks the way it does. They are all interconnected.
The dilution is the gravity acting on the rocket ship.
That's a great way to put it. And if you don't account for gravity in your trajectory calculations, you are going to miss the moon.
I want to circle back to that revenue bridge idea for a second. You mentioned looking at unit economics. If the author doesn't have internal data, how can they reasonably estimate that?
That's a fair challenge. They can use proxies. Look at the safe benchmark sector average the report already includes. It lists a price to sales of 4.5x. Look at other public companies in the asset tokenization space. What are their revenues per client?
Right, create a comparable.
Exactly. If a competitor has 100 clients and makes $10 million, that's $100,000 per client. DVLT would need 2,000 clients to hit 200 million. Does that seem feasible for a company with 6 million in current sales? It just puts the scale of the challenge into perspective.
And that's what the reader needs. They need to know if the mountain is climbable, not just how high the peak is.
Precisely. Let's wrap this up. We found some real opportunities to take this analysis from a standard report to a top-tier critique.
To recap, the main structural changes are moving from just reporting guidance to actually stress testing it, mathematically modeling the dilution into the price targets, and linking those technical failures directly to the company's cash needs.
That covers the big picture perfectly.
So, for the listener, here are your actionable takeaways for the next draft. First, build that revenue bridge model. Don't just accept the $200 million target. Break it down. Test its feasibility.
Second, adjust that $4 price target. Create a table that shows the fully diluted price based on a projected share count increase. Show the reader the real cost of survival.
And third, qualify the breakout zones. Don't just call 80 cents a resistance level. Analyze it as a potential dilution zone based on the company's cash burn and their filing history.
And finally, dig deeper into those data monetization assets. Don't just let the buzzwords slide. Evaluating the commercial viability of those patents is key to validating the entire thesis.
We would love to see how you refine this report. Take these sharper analytical lenses, apply them, and submit your work back in for another review. We're excited to see the next iteration.
Absolutely. It's a great start. Now make it bulletproof.
Don't forget to like, share, and subscribe for more.